Mark your calendar for May 29, 2026, because something is about to happen in the Bitcoin market that every investor needs to understand. A total of 80,535 Bitcoin options contracts worth $6.25 billion are set to expire on Deribit, the world's largest crypto options exchange, on May 29, 2026. This is the largest single options expiry since January 2026, and it is creating a very specific and very predictable setup that is already moving the market. Right now traders are piling into $82,000 call options at an extraordinary rate. The $82,000 call became the most actively traded single option product on Thursday, May 21, 2026, with approximately 1,600 contracts traded and a notional value of around $126 million in a single day. At the same time, the max pain level sits near $77,600, which is very close to where Bitcoin is trading right now, and Deribit's total open interest has now reached $31.3 billion, overtaking BlackRock's IBIT at $27 billion as the dominant force in Bitcoin derivatives. In this video I am going to explain exactly what all of this means, how Bitcoin options expiry works, why May 29th matters, the two scenarios for Bitcoin's price, and what you should do right now to prepare. Let's get into it. Before we get into the specific numbers, let's explain how Bitcoin options expiry actually works, because most people have never traded options and the mechanics are important for understanding why this event matters so much for price. A Bitcoin options contract is an agreement that gives the buyer the right to buy or sell Bitcoin at a specific price called the strike price on or before a specific date called the expiry date. There are two types of options. Call options give the buyer the right to buy Bitcoin at the strike price. If you buy a call option with a strike price of $80,000, you are betting that Bitcoin will be above $80,000 at expiry. If Bitcoin is at $83,000 when the contract expires, you profit from the difference. Put options give the buyer the right to sell Bitcoin at the strike price. If you buy a put option with a strike price of $75,000, you are betting that Bitcoin will be below $75,000 at expiry. Now here is the concept that is critical for understanding how expiry affects price. It is called max pain. Max pain is the price level at which the largest number of options contracts expire worthless, meaning both call buyers and put buyers lose the most money. Why does this matter? Because the sellers of options, which are typically market makers and large institutions, have a financial incentive to keep Bitcoin's price near the max pain level at expiry. They do this by hedging their positions in the spot market, buying or selling actual Bitcoin to keep the price from moving too far from max pain. This creates a gravitational pull toward the max pain price as expiry approaches. For the May 29, 2026 expiry, the max pain level is at $77,600, and Bitcoin is currently trading very close to that level. Now let's look at the specific positioning data for the May 29th expiry, because the numbers tell a very precise and very interesting story. Total contracts expiring, 80,535 contracts worth $6.25 billion on Deribit on May 29, 2026, put-to-call ratio, 0.86. This means for every 86 put contracts which are bearish bets, there are 100 call contracts which are bullish bets. A ratio below 1.0 indicates overall bullish sentiment among options traders. Max pain level, $77,600. This is approximately $2,000 below Bitcoin's current trading price of around $77,000 to $78,000. The largest put concentration, the $75,000 strike price, holds the largest concentration of put options with $394 million in notional value. This means a very large number of traders have bet that Bitcoin will fall to or below $75,000 before May 29. If Bitcoin does not reach $75,000 by expiry, all of those put contracts expire worthless and those traders lose their premium. The largest call concentration, the $80,000 strike price, dominates on the call side with $532 million in notional value. This is the level where the largest number of bullish bettors are positioned. Most actively traded single option. The $82,000 call strike became the most actively traded option on Thursday, May 21, 2026, with approximately 1,600 contracts and $126 million in notional value traded in a single session. This tells us that a significant number of traders are specifically betting that Bitcoin will break above $82,000 before May 29. Deribit open interest. Deribit's total Bitcoin open interest has now reached $31.3 billion, overtaking BlackRock IBIT ETF options which stand at $27 billion. This means the crypto-native derivatives market is now larger than the regulated ETF options market, a significant shift in where the smart money is positioning. Now let's talk about the two scenarios that are in play heading into May 29th, because understanding both sides of this trade is what separates informed investors from those who get caught off guard. Scenario A is the bullish breakout. In this scenario, Bitcoin breaks decisively above $80,000 before May 29th and pushes toward $82,000 or higher. How does this scenario unfold? If Bitcoin breaks above $80,000, the $532 million in call options at the $80,000 strike start to move into profit. This can trigger what traders call a gamma squeeze. When call options move into the money, the sellers of those options, who are typically market makers, need to buy actual Bitcoin in the spot market to hedge their exposure. This buying pressure pushes Bitcoin's price higher, which causes more calls to move into the money, which requires more hedging buying, which pushes price even higher. The 1,600 contracts betting on $82,000 specifically suggests that a meaningful number of sophisticated traders expect exactly this scenario to play out. In this scenario, traders who are long Bitcoin or who hold call options would benefit significantly. Scenario B is the max pain pullback. In this scenario, Bitcoin gravitates toward the max pain level of $77,600 and stays range-bound between $75,000 and $78,000 through May 29th settlement. How does this scenario unfold? Market makers who have sold large numbers of both call and put options have a structural incentive to keep Bitcoin near max pain. They do this by selling Bitcoin when price rises above max pain and buying Bitcoin when price falls below max pain. This creates a pinning effect. Bitcoin gets pinned near $77,600 and neither bulls nor bears win at expiry. In this scenario, traders who bought options on either side lose their premium and market makers collect the maximum profit. As CoinDesk noted in their May 21st analysis, the put-to-call ratio of 0.86 reflects a modestly bullish market, though with max pain sitting $2,000 below the current price, a gravitational pull towards $75,000 remains a real risk heading into May 29th settlement. Now here is something very important that most coverage of this story is missing: the Deribit versus IBIT dynamic and what it tells us about where the smart money actually is. Deribit is the world's largest crypto-native options exchange. It operates offshore and primarily serves sophisticated crypto traders, hedge funds, and market makers. BlackRock's IBIT is the world's largest Bitcoin ETF, and it has its own options market that trades on regulated US exchanges. Until very recently, IBIT options had more total open interest than Deribit, meaning the regulated US market was larger than the crypto-native market. That relationship has now flipped. Deribit's Bitcoin open interest at $31.3 billion has overtaken IBIT at $27 billion. This is a significant signal for two reasons. First, it tells us that sophisticated derivatives traders are increasingly using the crypto-native market rather than the regulated ETF options market. These are not retail investors, these are the most sophisticated participants in the Bitcoin ecosystem. Second, it tells us something about the nature of the positioning. IBIT options carry longer average maturities than Deribit contracts. This means the IBIT market is more about long-term positioning while the Deribit market is more about short-term tactical trades. The current Deribit dominance tells us that short-term tactical positioning is extremely active right now, which is exactly what you would expect heading into a major expiry event. The Crypto.News analysis from May 21st noted that whether Bitcoin clears $80,000 or gravitates towards $75,000 will determine which side absorbs the larger loss at the May 29th settlement. Now let's talk about the macro context that is making this options expiry even more significant than it would normally be, because Bitcoin's price action heading into May 29th is not happening in isolation. It is happening against a backdrop of several important macro factors. The first macro factor is geopolitical uncertainty. Iran tensions have been a persistent pressure point for Bitcoin throughout May 2026. The Strait of Hormuz situation has kept oil prices elevated, and any escalation or de-escalation of that situation could cause sudden price moves that cut right through the technical options levels. The second macro factor is the Federal Reserve. New Fed Chair Kevin Warsh has his first FOMC meeting on June 17, 2026. Markets are watching every macro data point between now and then for signals about whether he will cut or hold rates. Any surprise inflation data before May 29 could directly affect Bitcoin's price heading into settlement. The third macro factor is the Clarity Act. Galaxy Research analyst Alex Thorne raised Clarity Act passage odds to 75% on May 21, 2026. Any new headlines on the Clarity Act between now and May 29 could cause sudden moves in the crypto market that affect options positioning. The fourth macro factor is corporate Bitcoin accumulation. SpaceX confirmed 18,712 Bitcoin on its balance sheet worth $1.29 billion in its IPO prospectus filed this week. This makes SpaceX one of the largest corporate Bitcoin holders. This kind of institutional accumulation creates a structural bid that can absorb selling pressure and prevent Bitcoin from crashing too far below max pain. Now let's also talk about what happens after May 29 settlement, because this is something very few investors think about, but it is critically important. Options expiry events create volatility both before and after settlement. Before expiry, the max pain gravitational pull can compress Bitcoin's price range. After expiry, the constraints disappear and Bitcoin can move more freely in whichever direction the underlying fundamental support. Historically, some of Bitcoin's biggest short-term price moves have come in the days immediately after a major options expiry, as the pinning pressure disappears and the market reasserts its true direction. Looking at what comes after May 29, the next major event on the calendar is the FOMC meeting on June 17, 2026. If Bitcoin clears $80,000 after May 29 settlement and sustains that level, the path toward the 200-day moving average at $82,000 opens up. A clean break above the 200-day SMA with volume confirmation would be a significant technical signal. If instead Bitcoin falls below $75,000 after May 29 settlement, the next major support levels to watch are $74,604, which is the SAR support, and $72,000, which analysts have identified as the next major accumulation zone. The halving cycle math is also relevant here. April 2026 was 24 months after Bitcoin's April 2024 halving event. In previous cycles, the biggest price moves arrived 12 to 18 months after the halving, which would place the peak window between April and October 2026. We are currently still inside that window. Now let me give you the practical framework for what you should do right now as a Bitcoin investor with May 29 approaching in just 5 days. Action 1 is to understand which side of the trade you are on. If you are a long-term holder who bought Bitcoin below current prices, you are in a relatively comfortable position. The max pain mechanism may cause some short-term volatility, but it does not threaten your position unless Bitcoin breaks significantly below your cost basis. If you are a recent buyer near $77,000 to $80,000, you should be aware that price could be volatile in both directions around May 29 settlement. Action 2 is to avoid leverage around expiry. Leverage traders are the most vulnerable during options expiry events. Sudden price spikes in either direction can trigger liquidations before the price reverses. If you are using leverage in Bitcoin futures or perpetuals, the days around May 29 are a time to reduce exposure or tighten your stop losses significantly. Action 3 is to watch the $75,000 level. The $394 million in put options at $75,000 is the level that matters most on the downside. If Bitcoin falls below $75,000 before May 29, those puts start to move into profit and could trigger additional selling as put buyers hedge their gains. A clean break below $75,000 would be a bearish signal regardless of the options expiry context. Action 4 is to watch the $80,000 level. The $532 million in call options at $80,000 is the level that matters most on the upside. If Bitcoin breaks above $80,000 with volume confirmation, a gamma squeeze toward $82,000 becomes possible. Action 5 is to watch the volume. A genuine breakout above $80,000 requires strong volume confirmation. If Bitcoin moves toward $80,000 on thin volume, it is more likely to be a false breakout that gets pushed back down by market maker hedging. So let's bring this all together. On May 29, 2026, a total of 80,535 Bitcoin options contracts worth $6.25 billion will expire on Deribit. This is the largest Bitcoin options expiry since January 2026. The key numbers to understand are these. Max pain is at $77,600. This is the gravitational center and Bitcoin is currently trading very close to it. The largest put concentration is at $75,000 with $394 million in notional value. A break below this level would be bearish. The largest call concentration is at $80,000 with $532 million. A break above this level could trigger a gamma squeeze toward $82,000. The most actively traded single option is the $82,000 call strike with $126 million traded in a single day on May 21, 2026. Deribit's total open interest has reached $31.3 billion, overtaking BlackRock's IBIT at $27 billion. The put-to-call ratio of 0.86 reflects modestly bullish overall sentiment, but max pain gravity remains a real constraint until after settlement. Watch the $75,000 level on the downside and the $80,000 level on the upside. Avoid leverage around settlement. And remember that some of Bitcoin's biggest short-term moves have come in the days immediately after major expiry events when the pinning pressure disappears. If this video helped you understand the May 29th options expiry, please hit the like button and subscribe to the Crypto Skill for daily crypto updates. Drop a comment below. Are you bullish or bearish on Bitcoin heading into May 29th? I want to know.